All right. So now we will talk about different techniques, right, for inventory valuation, and how do you also deal with. So we already talked about the initial measurement, right, which is at cost, and then we will also try and understand about the subsequent measurement of inventory, which I've talked about, which is the cost to market price, whichever is lower, and we will try and understand this with the help of, in a way, a few examples. So when you look at the measurement of cost, right, we've talked about this. It could be standard cost, or like a retail inventory method. Standard cost, what it does, it takes into account the normal level of material, labor, efficiency, and capacity utilization, right? It is in a way, instead of trying to figure out, cost for every piece which is being produced, you box your factory with standard output, with standard cost, standard labor, and other overheads, and then you figure out your cost of production, and you try and approximate, you try and test all of this, right? That whether your assumptions are appropriate or not, it should be reviewed and revised regularly. So there's a very elaborate, in a way, methodology, which is a standard costing, which I'm sure you have also read and understood in detail in your costing paper as well. Okay. A retail method is another way of inventory valuation, normally in a way being used in retail industry. So it's not that you can apply any method in any situation. You got to apply method which in a way represent cost. That's the important thing. Cost or market price, whichever is lower. That's the objective of, in a way, inventory valuation. Here, how you determine cost? Cost is determined by reducing the sales value by appropriate percentage of gross margin. So how do you determine sales value by appropriate percentage of gross margin for inventories of large numbers of rapidly changing items with similar margin? As I said, in a large retail format store, your large number of items are coming, going, coming, going, but your margin at which you intend to sell, and you have retail price, which is fed into your system, your sales system. That is how, in a way, you try and pick up your cost as well. So let's try and understand this with the help of an example. So we have Awesome Fashions Limited is a new luxury retail company which is located in Bandra. The following transaction took place, right? One of the Awesome is beauty products, particularly that the Awesome Fashion Limited on average makes a gross margin of 55% on each line. Okay, so whatever is my sales price, I know, and then I make a gross margin of 55%. That's situation A. There's another situation B. Awesome Fashion Limited also sells handbags. It manufactures its own handbags as they wish to be assured of the quality and craftsmanship which goes into each handbag. Now, are manufactured in India factory, which has made handbags for the last 50 years. Normally, Awesome Fashion Limited manufacture 100,000 handbags a year in their handbag division, which uses 18% of the space and overheads of the head office factory. These division employ 10 people and is seen as being an efficient division within the overall company. Now, in accordance with Ind AS 2, explain how the items referred to in A and B should be measured. So how in A and B should be measured. So again, if you look at it, a simple example that I'm in a retail business and I have a large number of items which are similar type, similar costing. I know my sales price. I know what margin I make. So I'm going to follow a retail method, right? And similarly, when you look at B, it's a fairly standardized process, established, efficient. I know, the production I can do. I know the my overheads. I know what my direct labor. So I can do a standard costing method, right? So these are the different methods. So retail method can be used to measure inventory of the beauty products. The cost of the inventory is determined by taking the selling price of the cosmetics and reducing it by the gross margin of 55%. Okay. Now the handbags can be measured using the standard cost, especially if the results approximate the cost. Okay. Now, given that the company has the information reliably on hand in relation to direct material, direct labor, direct expenses, and overheads, it would be the best method to use to arrive at the cost of inventories. All right. Now let's talk about the some of the formulas, right? This is the method, which is like the retail method or the standard costing method. Let's look at some of these formulas, and as I said at the beginning, right? Now these formulas are very important for you to apply it consistently, and what you follow can actually result into a different impact in your profit and loss account, right, or in your balance sheet situation at any particular point in time. So you got to be careful what you apply, and also you need to apply it consistently. Okay, and we'll try and understand this, that if you were to follow this versus that, how is your profitability or balance sheet is going to look like. So one is, so there are three methods, right? We talked about. One is a specific identification method. Then you had the FIFO method, and then you had the weighted average cost method. Okay. So let's talk about the specific identification. Specific identification of individual cost is required for items not ordinarily interchangeable and goods or services produced and segregated for specific projects. Okay. FIFO, when there are large number of inbounds, outbounds are happening, assume that items purchased first are sold first. Therefore, inventory at period end is most recently purchased or produced. Similarly, weighted average cost, it actually looks at the computation of cost of items at the beginning of the period, okay, items at the beginning of period, and okay, cost of similar items purchased or produced during the period. So these are three different ways of looking at inventory valuation. Okay, specific identification, FIFO, or weighted average cost. Specific item, when actually you can identify that item, in its independent capacity. All right, easier. They're large units, right? Large items. Okay, then it's easier for you to do that. Let's say you're trying to value ships, right? And you won't make hundreds and thousands of ships in a year, right? So you'll make 5, 10, 2, 3, 4, depending upon the size of your operations, and hence you will figure out your cost, right, for each of the ships, right, independently. But let's say if you're making cars, right, you're making large number of cars, so you may follow a FIFO method, right? The cost of which has been produced first is considered sold first. So whatever is last cost of production, in a way, is considered inventory the period most recently purchased or produced. Okay, so whatever you produce first is considered sold first. Okay. Similarly, weighted average, which looks at the items at the beginning of the period and cost of similar items purchased during the entire period, is averaged out, and you get the average cost. Okay, let's try and understand this with the help of an example. So Spectrum Limited uses a periodic inventory system. The following information relates to 2019-20. So again, date, particular unit, cost per unit, and total cost. Then in April, May, September, and February, they've done these purchases of 2,000 unit, 500, 4,000, 3 at different price points, right? 10, 11, 12, 14. So total units I purchased is 10,000, and my total cost is 1,22,500. How much is my physical inventory at the end of the year is 4,000. Now this is an important information. End of the year, my physical inventory is 4,000. Calculate the ending inventory value and cost of sales using two different methods, right? Which is FIFO and weighted average. So how do you need to value your inventory following two different methods, which is FIFO and weighted average. Now FIFO means what? First in, first out. Now how much is my inventory which is left? My inventory which I have left with is 4,000 units. Now how much I purchased during the year? I purchased during the year 10,000. How much I'm left with? 4,000. That means how much I've sold? 6,000. Okay. So first in, first out. That means first 2,000 they already sold. 500 also. Other way of looking at it, very simply, 4,000 is last 4,000, which is 3,500 purchased at the rate of 14 rupees, and then out of 4,500 is left. So 500 into 12 rupees. Okay. So this is relevant from a FIFO perspective. And when you do weighted average, then for everything in a way is relevant. What is my average cost? and that's how my answer will change. Okay, now when I do FIFO here, the 3500 into at the rate of 14 and 500 at the rate of 12, I get to 67,500 as my closing. Sorry, my 55,000 as my closing value of inventory and 67,500 as my cost of sale, which is 1,22,500 minus 55,000. So my inventory value, if I were to follow FIFO, is 55,000. Okay. Now, if I have to follow weighted average, okay, what is my inventory value? My weighted average inventory is 49,000. Try and see this difference. How I've done this? 1,22,000 total cost divided by 10,000 unit, which is during the year which I had. 12.25 is my average cost, weighted average cost, weighted to the units and the price, right? So that's why it is called weighted average cost, 12.25. 12.25 into 4,000, which is the closing inventory. That gives me 49,000. That my cost of sales here is 73,500 compared to the cost of sales. If I were to do FIFO, is 67,500. So accounting is a period concept, and that's why it's extremely important for you to follow this consistently. Okay, consistently. So same method, if you will follow consistently, then it will catch up. Your profitability will catch up over a period. Okay. So, but your answer in a particular accounting year is going to be different. All right. That's why it is important. Okay. Subsequent measurement. Inventories are measured at the lower of cost and net realizable value. Subsequent measurement are lower of cost and net realizable value. Now, what's the definition of net realizable value? Net realizable value is defined as fair value less cost to sell. Okay, is estimated selling price in the ordinary course of business less the estimated cost of completion and estimated cost necessary to make the sale, right? So if you are dealing with work in progress, then it is, of course, you got to also incur cost to process it, and then cost which is necessary to be incurred to eventually complete the sale process. So what is my net realizable value? Is my cost less my additional cost necessary to complete the production process and less the cost of sales cost, right? Estimated cost necessary to make the sale. That gives me the net realizable value. Now, an example of that could be A Limited has inventory worth INR 40 lakhs, and transportation cost of INR 5 lakh will be required to complete the sale. That means what? My NRV is actually 35 lakhs, okay? Not 40 lakhs. 40 lakhs minus 5 lakh is the transportation cost, okay? Now, we will try and do this again in greater degree of detail, okay? So NRV equals to estimated selling price less estimated cost to complete, less estimated cost to complete, less estimated cost to sell, okay? Again, try and understand this. It may not be recoverable. So what could be the reason that why my inventory has to go down below cost, right? There could be a variety of reasons, and the reasons could be damage, could be obsolescence, could be decline in selling price, especially if you're dealing with commodities, right? Because the raw material prices itself changes. The cost of finished goods also keeps on changing, right? Like in steel, right? Like in copper, like in oil, right? Because the oil prices changes, the finished product price also change. Okay, so damage, obsolescence, decline in selling price, or additional cost needed to complete the manufacturing process. Okay, it should be based on fluctuation of price of cost is held. Now, this is important as a concept. Okay, because what happens many times is that inventory is often not traded. Okay, in a way they're not quoted on an exchange. They're not quoted on an exchange. Ordinarily, if they're quoted, then that's a different issue. But if they're not quoted on an exchange, then there's a subsequent decline in the value of the inventory, right? Before you authorize your financial statements for issuance under Ind AS 10, for example, adjusting a subsequent event subsequent to the balance sheet, they're ordinarily considered as adjusting events. Okay, so events, these are ordinarily considered as adjusting events. adjusting it. That means you got to adjust your price, your assessment of NRV, right? If there are events has happened. But if let's say there's a fire which has happened subsequent to the balance sheet, then you don't need to adjust it, right? Which has resulted into damage. So that's a non-adjusting event. You may have to do a disclosure. Okay. So it depends. It depends on the facts and circumstances. But in general, we've seen in practice that you got to adjust it. Okay. Now, when you look at the NRV as a concept, a review of all inventory should be made in each period. And if there are circumstances causing write down no longer exist, then you're allowed to write it back, right? Up to your cost. You can write it back up to your cost. Now, if the materials used in production process, they are not written down below cost if the finished goods will be sold at a profit. So this is also an important principle. So if there's a work in process, there's a work in process is 10 rupees. And today, if you buy the same work in process, you can buy for 9 rupees. Okay. But if you can sell the finished goods at 15 and your additional cost to complete is only 5, that means 15 and versus 15, you're still okay, right? So that's an important understanding, right? So if I can do more value add through the manufacturing process, and essentially I will be able to recover my cost of manufacturing, then you don't need to write it down. Okay. But if you're not able to recover your cost of manufacturing, then of course we need to write it down. Let's just try and understand this with the help of an example. All right. Now, Sun Limited, while determining the net realizable value of its inventories, requires guidance on whether the following cost should be considered in NRV determination or not. Trade discount expected to be allowed on sale. So if I were to offer a trade discount, right, that has to be then, in a way, that's a sales cost. If I cannot sell it, at market price. Now I have to offer a discount. So that has to be considered in determining my NRV. Now, cost of completion. Yeah, this is required to be incurred cost to actually before I must sell this. I need to incur this cost. So I need to cash discount expected to be allowed for problem. No, cash discount, that's after the sale I'm trying to collect, right? Then incentivizing the buyer to make the early payment. So that's not related to my NRV, and hence no. So this yes, this no. Okay, let's look at the solution. Ind AS 2 defines net realizable value as the estimated selling price in the ordinary course of business less the estimated cost to complete less the estimated cost to sell necessary to make the sell. Now, trade discount is a reduction granted by a supplier from the list price other than for prompt payment, and hence it should be deducted. Trade discount should be deducted. Okay, as I explained. Now, when I look at the cost of completion of work in process are incurred to convert the work in progress into finished goods. Now, since these costs are in the nature of completion cost, the same should be deducted from the estimated selling price. So they are also to be deducted to determine the NRV of work in progress. Now, cash discounts is a reduction granted by a supplier from the invoiced price in consideration of immediate payment or payment within a stipulated period. So we don't need to, right? Should not be considered. Same should not be considered while determining the NRV. All right. Let's talk more with few more examples. Okay. Now, this question here. Now, Neptune Limited, a cabinet manufacturer, has 500 units of raw material inventory on hand as at 31st of March 2020 with a carrying amount of INR 1,000. The current market value of that timber is INR 950. Okay. Neptune Limited intends to use the timber to manufacture cabinets. Okay. So you're going to use it to manufacture the cabinets. You purchase it for 1,000. Your carrying amount is 1,000. Your current market value of timber is 950. Now, Neptune Limited estimates cost to completion and sale of 500. Right? Cost of completion and sale is how much? 500. And a selling price for the cabinet of INR 1600. So my selling price of the cabinet is INR 1600. Okay. So the question here is, do I have a loss here? Net realizable value of timber is how much? 1600. How much is the cost to complete? 500. So how much I'm going to realize? 1100. What's the current? What's my carrying value? Is 1000. That means there is no loss which I need to record, even though the value of the raw material is 950. Okay, I'm still not required to record a loss. That's the principle we just picked up, right, on subsequent recognition. Okay, that if there are raw material used in the production process and the end product can be sold at a profit above cost, you don't need to record the loss and the intermediate cost item. Okay, let's look at another example. This is a good example. Okay, now on 31st of March 2019, Platinum Limited, all right, Platinum Limited, inventory includes spare parts, which it had been supplying to a number of different customers for some years. The cost of spare parts was INR 100 million, and based on retail price at 31st March 2019, expected selling price of the spare part is INR 120. Okay, how much was my cost? 100. And how much was my expected selling price on 31st of March? 120. On 20th of April 2019, okay, due to market fluctuations, expected selling price of the spare parts in stock reduced to 80 million. Huge reduction, right? The estimated selling expense required to make the sales would be INR 5 million. The estimated sales expense also. Now, financial statements were authorized by Board of Directors on 25th of April 2019. So, in a way, there's a subsequent event, and as I had said, this is an adjusting event. Okay, for inventory valuation, unless it is like a quoted a commodity, from that perspective. So, which again is a matter of judgment here. Now, as at 31st of March 2020, directors of Platinum Limited, now we move to the next year, right, noted that such inventory is still unsold and lying in the warehouse of the company. Now, directors now believe that the inventory is in a sellable condition and active marketing could result in an immediate sale. Since the market conditions have improved, the estimated selling price of inventory is INR 110 million. And estimated cost are INR 5 million. Okay, let me grab some water. Now, the question: what will be the value of inventory at the following dates? So 31st of March 2019 and 31st of March 2020. Now, when I look at the solution, as I said, right, so your cost carrying value was 100, but now at the 31st of March, it was 120. But then before your financial statements were authorized for issue, it came down to 80, and then 5 was the selling cost. That means 75, right? That means you got to record a loss, right? So how is the cost, load of cost and net realizable value? And as per Ind AS 10, events after decline in net realizable value below cost provide additional evidence of event occurring at the balance sheet date and hence shall be considered as adjusting event. Okay, remember all of these are an area of judgment. For valuation of inventory at 31st March 2019, my cost was 100. My net realizable value is 75. So I'm going to record a loss, lower of cost and net realizable value, which is at 75 million. Okay, that was I need to record a write down of 25 million in the income statement. Now I move to next year. Next year, now I realize that inventory is still out there, but the board have now made an estimate. The selling price is now 110, and I'm going to make a cost of 5. That means my realizable value is now 105. What was my cost? 100. The carrying amount, original carrying amount was 100. That means whatever loss I've recorded during the year, I'm allowed to reverse, right? A new assessment is made, states that the increase in realizable value because of change economic circumstances, the amount of write down is reversed. So cost was 100, net realizable value was 105, which is 110 minus 5. So inventory is now going to record at INR 100, and I'm going to record a 25 million of reverse, right? INR of 25 million loss shall be reversed. Now that's an important principle. So all the four unique things we talked with the help of an example, right? So if there is a subsequent decline in value, right, which is akin to an adjusting event, that also you need to consider. If your raw material, whose value is declined, but if you can generate, you can derive more from the finished product in which it is to be used, then you don't need to record a loss in value of the inventory. If you have recorded a loss which subsequently have been recovered, then you're allowed to in a way reverse that loss. The reasons at which you may have an inventory loss in value because of damage, obsolescence, or change in market factors, and so on and so forth. So you got to look at cost or market price, whichever is lower. And I also talked about you got to follow the formulas consistently, because as you remember, as you can see, my answers were different, right? My answers were different in different formulas. So if I follow FIFO, my inventory cost was different, my cost of sales was different. If I follow weighted average cost, my cost of inventory was different, and my cost of sales was different, right? Same formulas to be used for inventories of similar nature and use. Different cost formula may be justified for inventory with different, right? It's not that change is not permitted. Change it, you got to apply it appropriately. Apply it appropriately. Again, look at Ind AS 10, and you would apply it for all the periods present, right? It's a change in accounting principle. Okay, it's a change in accounting principle. Okay, let's look at an example, right? Now, Captain Pharma Limited, a renowned company in the field of pharmaceutical, has the following items in inventory. The cost and net realizable value is given as follows. Okay, ABCD, 20,000, net realizable value is 19,000. B is 50,000, it is 51,000, 44,000, 45,500, 32,000, 29,900. So that's my total cost. Now, determine the value of inventory on an item by item basis or on a group basis. So if I were to do it on an item by item, then what's the value of inventory? If I were to do it on a group basis, then what's the value of the inventory? Inventory shall be measured at the lower of cost and net realizable value. That's the principle. So if I were to do it on item by item, then A, I'm going to take 19,000. B, I'm going to take, so again, if you look at this, right, I go back to the question, right? If I do an item by item, this is lower. So I'm going to take this. Here, I'm going to take this. Here, I'm going to take this. Here, I'm going to take this, right? So for A and D, I'm going to take the market price. For B and C, I'm going to take the cost, okay? So that's how I'm going to do it, okay? That's how I'm going to do it. If I were to do it an item by item, right? 19,000, 50,000, 44, 19, which is 1,42,000. But if I do it on a group basis, then it comes to 1,40,400, 1,45,400. So your policy is extremely important. First, you need to determine what is an appropriate policy, and then you need to apply it consistently. Apply it consistently. You can follow group depending the items are homogeneous in nature. As I said, they're all types, similar purpose, size, type of customers, market, geography. Then you can do that. In some circumstances, however, it may be appropriate to group similar or related items, right? In some circumstances, group similar, and this may be the case with items of inventory, same product line that have similar purpose or end users. Okay, let's quickly summarize what we have talked about. What are the different techniques for measurement of inventory? Okay, retail method we talked about, which is applied, in retail industry. Then standard costing, where it is very efficient. You can measure your cost of production, leveraging standard cost, but you got to continuously, in a way, compare with actuals. Or the cost formulas, right? You can use a specific identification, you can use a FIFO or weighted average. Now you got to be consistent, right? Formulas have to be consistent, right? Same cost formula for all inventories of similar nature and size. And net realizable value, what's the meaning of net realizable value? Is your carrying value less your cost to completion and less your cost to sell. Okay. So NRV, estimated selling price, less estimated cost to complete and sell. All right. That's what we understood in terms of different concepts. And we've also, of course, picked up, what's the meaning of NRV with some examples, right, in different situations. Lots of examples which we talked about. Okay. Now we're going to talk about a very important concept, and again we'll do a detailed, in a way, a case study here to understand how do you value inventory when you have when you're in the production process. There are multiple products which are coming out, or there's a byproduct, in a way, which comes out, right? So if there are joint products and byproducts, right? So how do you, in a way, get to the inventory valuation process? So you using, let's say, what happens in a refinery process, right? When you actually doing a refinery, the crude is the raw material which goes in, okay? But all of you get the petrol, you get the diesel, you get these, you get that, all kind of stuff, in a way, which comes out, okay? In the refining process, okay? There are multiple outputs which you actually receive, and if there are byproducts by nature are something which are immaterial in value, okay? If that been the case, what is the principle is normally we follow. Let's just try and understand the principle, okay? And then we will follow this with the help of a example. A production process may result in more than one product being produced simultaneously, right? That is the case, for example, when joint products are produced, or when there is a main product and a byproduct. Now, when the cost is not separately identifiable, they are allocated between the products on a rational and consistent basis. Accounting is all about logic, okay? On a rational and consistent basis. The allocation may be used, for example, on the relative sales value. Now, this is important, right? For example, if you don't know the specific cost, on the relative sales value of each product, either at the stage in the production process, or when the product becomes separately identifiable, or at the completion of production. So whenever you've been able to identify them. Now, most byproducts by their nature are immaterial, okay? Are immaterial. Now, when this is the case, they often measure at net realizable value, and this value is deducted from the cost of the main product. So remember, byproduct are generally considered to be immaterial, and if they are labeled as byproduct, then you want to measure them at net realizable value and reduce that net realizable value from the cost of the main product itself, right? From that perspective, as a result, the carrying amount of the main product is not materially different from its cost. Okay, all right. Now, if the byproduct is if it actually is material, then it is no longer considered as a byproduct. Then it's become part of a joint product. Then it is called as a joint product. Then how do you allocate? Then based on, if you can identify the cost, then you do it on that basis, or if you can't, then based on the relative sales price, okay, of each of the products which are produced through the same production process. Okay, let's do this with the help of a case study. All right. Now, Jupiter Limited, in its manufacturing process, realizes one byproduct besides two main products, FG1 and FG2, apart from scrap. Now, details of the production process are as under. Raw material 14,500 units goes in, and you get the output 5,000, 4,000, and 2,000 of byproducts. The cost is 1,50,000, 90,000, 65,000, and 50,000, and you have closing inventories of 50,000 of product FG1, and FG2 is 250. All right. Additional information. Average market price of FG1 is 60, okay, and FG2 is 50. That's the average market price. And byproduct is sold at the rate of INR 30. It is sold at the rate of INR 30. There is a profit of INR 5,000 on sale of byproduct after incurring separate processing charge. There's a separate processing charge of INR 10,000 and packing charge of INR 2,500. INR 7,500 was also realized from the sale of scrap. Many things are happening here. Okay, you got to focus. Many things are happening here. So one is that we're doing a manufacturing process. There's a product A, product B. They anyway are main product, joint products. Then there's a byproduct called buy. Then there's a scrap, right? And then we have information on the total cost of production. Then we have information on sale price of FG1, FG2. Then we have also information that how much we realized from this byproduct. We've also realized something by selling the scrap, right? Now, I need to calculate, or we need to calculate the closing value of inventory of FG1 and FG2 as on 31st of December 2020. Okay, so remember the principle we said, if there are byproducts, first we need to reduce the NRV of byproducts from the cost of the production, right? And then if I can identify the cost of each of these joint products individually, then I'm going to value it on that basis. Now, if I can't, then I'm going to value it based on relative sales price. Okay, so I've got all the information here. Now I need to apply that in practice. Okay, so how much is my realizable value of the byproducts, right? So by how much I made 2,000 units of byproduct at the rate of 30. Then I had a 10,000 rupees of processing, 10,000 of processing, and then 7,000, no, 2,500 of packing, right? So let's look at step one. Okay, so I talked about the principles. Selling price of byproduct 2,000 into 330 is 60,000. There's a processing 10,000, packing 10. So my actual realization from byproduct buy is 47,500, right? So I'm going to ignore this profit of 5,000, right? That's the important concept you got to remember, right? Is because if it is a byproduct, it is considered immaterial, right? If it is to be considered as material, then it's no longer a byproduct. Then it will become a part of a joint product. Okay, so I'm going to ignore this 5,000. All right, on sale of byproduct is not relevant for working and hence ignored. Okay, now calculation of cost of conversion for allocation between joint product FG1 and FG2. So I have the total cost. Okay, how much is the total cost? Which is 1,50,000, 90,000, 65,000, and 50,000 is what was the given in the example, and then this is what I'm going to exclude. Okay, and this 7,500 was nothing but the sale of scrap. All these are excluded, reduced, right? Then I get my actual cost of production for the period is 300,000. Okay, now I need to determine how do I allocate 300,000 between FG1 and FG2. Okay, so I don't have the specific cost for FG1 and FG2 because they are in a way produced together. So I'm going to, but I know their sales price, right? Which was 60 and 50, right? And I also know the quantity which is being produced. Okay, so how much quantity of FG1 was produced? 5,000. FG2 4,000, right? So I know the quantity which was being produced, and then I'm going to look at the sales price is 60 and 50, and then 3 lakh and 2 lakh, which is multiply 55, 5,000 into 60. So I get the ratio of 3:2. And similarly, this 3 lakh rupees of total cost then needs to be allocated between FG1 and FG2 in the same ratio. I get this cost as 36 and 30, right? That's my cost of production. Okay, so output in unit A is 5,000, 4,000, sales price per unit 60, 50, sales value 3 lakh, 2 lakh, ratio of allocation 3:2, and then joint cost of INR 3 lakh, which I just determined, is allocated in the ratio of 1,80,000 and 1,20,000. So cost per unit is 36 and 30. All right. Now, determination of value of closing inventory of FG1 and FG2. Our value, now I know the quantity, right? Which is what I have, which is 500 unit I have here and 215 I have. So 36 is what I have determined and 30 is what I have determined. So 18 lakhs and 7 lakh 50,000. 7,500. 18,000 and 7,500. Okay, so when I look at, when I quickly kind of summarize, so when there are more than one product in the production process, they are joint products. So outcome of joint product, right? Or the outcome is main product with the byproduct. If I can identify the cost of conversion separately, then I'm going to look at them based on their individual cost, which when I'm not able to identify them, then I'm going to look at relative sales value, right? Depending on the stage at which they are then separable and identifiable, and the sales price at that stage. Okay. So depending upon the information which is available, again, remember, apply the rational and logical basis. Now, when the main product with the byproduct is immaterial, I'm going to measure at NRV, and this value is deducted from the cost of the main product. I'm going to ignore the profit here, ignore profit, if any, on sale of the byproduct. Okay. When the byproduct is material, then essentially we are saying that the byproduct is treated as a joint product. Then you come here, right? Byproduct is treated as a joint product. Accordingly, the accounting is being done. All right. Now let's move forward to talk about recognition as an expense. How do I deal with the carrying amount is recognized as an expense in the period in which related revenue is recognized. Okay, in the period in which related revenue is recognized, write downs to net realizable value and all losses of inventories as an expense in the period in which they occur. All of that, write down, and all expenses, all losses, all recorded as an expense. If there's a reversal, we saw in one example that there was a market condition improved, this reversal, that also is recorded as a reversal in the cost. They are not income. Okay, the record as a reversal of the cost. The amount of any reversal of write down of inventories arising from an increase in net realizable value shall be recognized as a reduction in the amount of inventory, recognized as an expense in the period in which the reversal occurs. Okay, let's look at an example on an inventory write down. Good Company Limited has 1,000 units of inventory D costing INR 100 each, lying unsold since last 6 months. These units were purchased a year ago in anticipation of high demand. However, it is unlikely that there would be any customer available in future. Unlikely that there would be any customer available in future. The best price available at reporting date is INR 70 per unit. How much I purchased for? 100, right? The best price is what? 70. So what do I need to do here? I need to record a write down. By how much amount? 30 rupees. All right. Cost of inventory 100 into 1000, which is 1 lakh. Okay. Net realizable value 70 into 1000 is 70,000. So I'm going to record compare the two, and I'll record a loss as 30,000. Okay. Loss on inventory debit 30 and inventory credit 30,000. This goes to profit and loss account, right? This goes to P&L. Okay. Being inventory, write down. Now, if I were to look at reversal of the same inventory, now, what if in the previous example, the inventory demands picks up later and can be easily sold for INR 110 per unit. Now, I can sell it for 110 per unit, right? Now, what is it I'm going to do? Initial write down shall be reversed only to the extent of loss which has been booked. Okay, so you're not allowed to record the unrealized gain. You are allowed to reverse the unrealized losses which you had booked. Okay, so what's the entry I'm going to pass? Inventory debit 30,000, which is the loss which I had recorded, and to gain on reversal of inventory write down credit. Okay, 30,000. Now, important thing is that this is going to go to balance sheet, and this is what goes to your profit and loss account, right? As a credit, as a reduction of overall your cost of sales. Okay, awesome. Now we've talked about the inventory write down and subsequent reversal of such write down. You're not allowed to kind of look at beyond in a way cost. Okay. Now, if I have an inventory which I've actually transferred to property, plant, and equipment, then what are the accounting principles? It happens. It happens in some situation. We don't see it very commonly, but it happens in some industries at times. We see that. Now, some inventories may be allocated to other asset accounts, right? For example, inventory used as a component during the useful life of that asset through charging of depreciation on that asset, right? So let's look at an example. Okay. Hardwork Limited has an item of inventory costing INR 200,000 as covered under Ind AS 2 is consumed in the construction of self-constructed property. Okay. to be accounted as property, plant and equipment under Ind AS 16. Now this 2 lakh in a way then gets loaded to your cost of construction, right? Other than inventory is INR 4 lakh. The cost of such property, plant and equipment other than inventories is INR 4 lakhs. And what do you do? Essentially, you will then capitalize this 2 lakh, right? Such inventory needs to be capitalized in the cost of property, plant and equipment. If the useful life of the property is 5 years, depreciation on such property charged to profit and loss account is INR 1,20,000 per annum. That is 600,000 divided by 5. Okay, so this 4 lakh plus 2 lakh, right? You want to and 2 lakh. So you're going to increase it to 6 lakhs. Okay. Yeah. Sorry. 6 lakh. Okay. We're going to capitalize 6 lakhs. Okay. We're going to capitalize 6 lakhs and then depreciate over a assuming a life of 5-year period. Okay. So we've talked about whole host of stuff, right? Whole host of stuff. And when you look at the inventory, the accounting principle for inventory is at cost. Okay. Then we talked about what all goes into cost, right? We said it's a purchase cost, conversion cost, and it's a other direct cost, other cost, right? Which is like interest cost or other costs which are necessary to bring the inventory to its present condition and location. Then we said, what's the purpose of inventory, right? Inventory is actually for a trading purpose, inventory is for production purpose, inventory is for in your services business to like a inventory which is to be used for service your customer, etc. Right? And then we said, inventory you want to look at cost or market price, whichever is lower. Okay. And we talked about cost, we talked about different examples that this is a direct cost, this is an indirect cost. Then we talked about how do you load these overheads, right, in the production process. And we said you determine the normal production capacity, figure that out, and then allocate based on the normal production capacity. Anything which is abnormal, sound abnormal, that needs to be expensed off as income. Now, if you've done production more than your normal production capacity, then we said you got to actualize the cost. You're not allowed to load more than what actual cost you have incurred. If it's a variable production overhead, then it is simple, right? It varies with the per unit of output, right? Then we said if there's a general administration and management cost that are not considered as costs which can be allocated to inventory. But if that is a plant administration, where the factory administration, of course, that needs to be allocated, right? Again, based on normal production capacity, etc., right? And then we picked up an example where different elements of cost which gets capitalized, which are to be. Then we talked about few examples which are to be excluded, right? Not to be considered, like abnormal cost, not to be considered. Okay. And then we talked about the subsequent recognition of inventory, so cost or market price, whichever is lower. We talked about the reversal, all of that with the help of several examples. And we also talked about joint products and byproducts, right? And how do you allocate cost. We also talked about the different methods of inventory valuation, right? To say that you can value inventory based on, let's say, retail method or a standard costing method. And then, but those are very specific in different industry types. And then we talked about to say when you apply the actual valuation, you can do valuation based on specific identification method or on a weighted average cost method or on a FIFO method. And we also saw with examples that your answer of cost of inventory or your charge to cost of sales can be different by following different methods. And hence it is extremely important for you to be consistent from one accounting period to another accounting period. And we also in a way realize that this concept that inventory is also an adjusting event. A subsequent also markdown in the value of the inventory is often an adjusting event and may require an adjustment if your financial statements are yet to be issued. All right. Now let's talk about disclosures. Disclose, and disclose. Disclose your accounting policy, right? Adopted in measuring inventories, including the cost formula, analysis of the carrying amount, an appropriate classification as finished goods, your work in progress, your raw material should be carried at fair value less cost to sell, amounts which goes into your profit and loss account, write down, if you've done any write down or any reversal, that also needs to be disclosed. If there is any inventory pledged as security, that also needs to be disclosed. Disclose. What are the differences between Ind AS and existing Indian gap. Not a whole lot, not a whole lot of differences. Okay. One is a measurement, in a way, do not apply to commodity broker traders, right? This is what we've talked about. Now, this is no scope exemption in AS2, inventories held by commodity traders. Here we have a scope exemption, the principal level differences. Then the producer of agriculture and forest produce, in a way, excluded because we have again in AS 41. So here also there are some in a way exclusions. Biological assets, we saw the exclusion. If the deferred settlement terms, we talked about that. Then it talks about the present value accounting and record that interest cost as a period cost. Here it is recognizable only if the contract states that interest is payable for deferred terms. So I think Indian gap to that extent, um, um, doesn't in a way account for the present value, go by more by the contract, and there could be an element of judgment there. If there's a write down, if there's a reversal, if there's a reversal, then reversal is permitted, right? In circumstances that previously caused inventories to be written down no longer exist. So if there's a reversal permitted, there is no specific guidance, but we do in practice, a write down or reversal under Indian GAAP as well. Okay. So that is what we had talked to you about Ind AS 2, about inventories, right? We've got some few more questions, right? Which I'm going to, my colleague is going to take you through all such questions as well. So do practice. Practice is key, right? For you to, in a way, get your concepts clear. As many solutions, as many questions, do practice. Okay. Once more and more practice will help you to get your concepts clear. All right. Thank you very much. ये क्वेश्चन बैंक तो वो कर लेगा ना